Hey everybody, and welcome to the third video from Chapter 11. Today we're going to be talking about contractual savings institutions. Specifically, we're going to be talking about pension funds and insurance companies. So let's first define what a contractual saving institution is. And it's just a financial intermediary that receives payments from individuals as a result of a contract and uses the funds to make an investment. And it's this term contract, which means that there's some sort of obligation that differentiates uh, these from the other types of investment in financial institutions that we've been talking about. In a pension fund, you've probably especially heard them referred to from like your parents or the people that are in the active long-term workforce. And a pension fund is just a financial intermediary that invests contributions of workers and firms into stocks, bonds, and mortgages to provide for pension benefit payments during worker retirements. And a pension fund, along with a 401k, are the two big employer offered ways to prepare for retirement. So we've talked about like IRAs and stuff. Well, pension funds and 401ks are employer offered. And with a pension, you receive pension benefits by working for a company or government for a certain period of time, after which they promise you that after you retire, they will continue to pay you a set amount of income as well as they may give you other types of benefits like insurance. And so it makes it really appealing because retirement is a major consideration when you get a job because you're not always going to have that working wage stream. And so you have to prepare for it by, saving. But with the pension fund, you don't have to save quite as much. So employers offer pension funds for two reasons. First, because it means that they can add an additional perk to incentivize individuals to come and work for them. And additionally, it means that their wage load is actually going to decrease a little bit because since pensions are so nice to have, then they don't have to necessarily give a worker quite as high of a wage. So it's mutually beneficial as well as just a good thing to have. And I know that pensions might seem a little bit obtuse or unnecessary. You might be questioning why we're talking about them, but they're actually super important to the US economy. In fact, pension funds owned over $19 trillion in assets, which makes them the largest institutional participant in capital markets. In fact, they own 20% of all financial assets that belong to US households. And you can see how they invest in front of you. So, private and state and local pension funds, they invest in a couple of different ways. So, the big difference that you'll see is that while this part of investments are quite similar, uh, private pension funds can invest in corporate equities and mutual fund shares, while state and local pension funds cannot. The reason for that is pretty simple. You can't have the government investing in private companies. So that's why they have replaced these equities and mutual fund shares with claims on sponsor. Now, pension funds before 1974 weren't very well regulated, but then the Employee Retirement Income and Safety Act changed some of this. It set standards for pension fund vesting, or how long you had to work before a company that offers a pension before you started to get pension benefits, as well as it also limited the types of assets that pension funds could invest in particular, the types of derivatives and speculative investments that they could make. Additionally, and this is quite important right now, pension funds are insured by the Pension Fund Benefit Guarantee Corporation or PBGC. They insure pensions up to $69,000 or $69,750 per year for a person who's 65 right now, which means that if a company who goes bankrupt guaranteed you a pension, the PBGC will pay that pension up to 69,750. However, this is problematic, and the reason for that is because public pension funds are drastically underfunded, and the shortage is greater than what the PBGC has in reserves, which means that potentially we could have a situation where if some public governments go bankrupt, the PBGC doesn't have enough reserves to pay off all the pensions, so we could in fact get a pension insurance crisis in the future. And it's by quite a lot. The shortage is at over $4 trillion when you consider that the entire pension ownership in the US economy is $13 trillion. It really puts into perspective the pension potential crisis. And there's a few different reasons for why there's such a big shortage, but the main ones that are major contributors to this crisis include declining property taxes in cities like Detroit, which has a very large pension package. And if you remember, Detroit actually did go bankrupt. Then there have also been low interest rates for the last 10 years, which means that like bond investments don't give nearly the required return necessary to get to the point where the firm can get to the promised amount that they're going to give their employees, as well as tax cuts. And tax cuts may seem a little bit weird, but the reason for that is just because since like governments can't operate on revenue, they don't have any product to increase their revenue, they increase their revenue through taxes. But when you cut taxes, that means you have to decrease government spending. Well, pensions, you can't just decrease. You can decrease it for new employees, but for existing employees, it's contractually obligated to them. So those tax cuts are potentially problematic because the revenue stream doesn't necessarily match what has to get paid out contractually to the employees. Now, on the flip side, insurance companies you may be a little bit more familiar with. And an insurance company is just a financial intermediary that specializes in writing contracts to protect policyholders for the risk of financial loss. And there's two main types. There's life insurance, which protects households against a loss of earnings from death, retirement, or disability. Uh, as well as there's property and casualty insurance, which protects firms from risks like illness, theft, fire, accidents, etc. So life insurance is just a little bit different because the main beneficiaries from a life insurance policy are not actually yourself. They may be like your family and etc. Which also means that only households can take out life insurance companies, while property and casualty insurance companies can go to both households as well as firms. Now, one of the main ways insurance companies actually make their money is by investing the premiums that you pay to them into the market. And so life insurance companies actually have over $8 trillion invested in assets and property. And casualty insurance companies actually have over $2.5 trillion in invested assets. So when you add those two together, you get over $10.5 trillion in financial assets owned by these insurance companies. And this looks at a little bit of what they're investing in. So a lot of bonds. That should be the big takeaways. You have these stable bonds as well as some stocks, but most of them really come from stable revenue streams. And the main reason why they really care about these stable revenue streams is because the whole idea of getting insurance is to protect in the event of an unforeseen accident or incident, which means that there's a lot of variability on what insurance companies need to pay out, so they need to have a stable source of income coming in. Now, profitability is going to really depend on their ability to avoid paying out those claims to clients. And one way they do so is by risk pooling. What if I was just, if I sold flood insurance in one city in the United States for maybe 10 years, I never have to pay out a single claim or maybe a couple. But then suddenly, let's just say there's a massive rain event, that there's a freak storm and the entire city gets flooded. That is a lot to pay out suddenly, and it's very difficult for insurance companies to take at once. So what they do is they pool risk so that they can take advantage of the law of large numbers. Because the law of large numbers, for those of you that don't know, is that as you increase the sample size of a group, you approach like the true value. So, for example, if I were to flip a coin heads or tails twice, I could get one head or one tail. 50% of the time I get a head, 50% I get a tail. However, you also have a chance of getting two heads or two tails. However, if I were to flip a coin 10 million times, I will get very close to flipping 50% of the time heads and 50% of the times tails. And insurance companies operate on this same logic. Now, it's not a perfect strategy because you still don't know with insurance, with like the probability of like flood damage occurring, you still don't know necessarily what the true value is. And that's what all of your friends in actuarial science are in charge of, is they have to figure out the probability of some adverse event occurring, forcing the insurance company to have to pay out on claims. But insurance companies do a lot on their own to try and prevent having to pay out claims. One of the big ways that is really talked about, especially over the last decade, but beyond that, is through pre-screening and risk-based premiums, which is why pre-existing conditions are such a big deal in the topic of health insurance. If somebody has uh, heart problems, they were born with some sort of heart problem, they are going to have more medical incidents, which means that the insurance company is going to have to pay more frequent claims on medical bills. Uh, and that's not necessarily good news for a for-profit insurance company. And so that's why mandates on things like pre-existing conditions are such a big deal, is because voluntarily it doesn't make sense for a for-profit corporation to, uh, especially at low cost, insure people with pre-existing conditions. But there are also moral hazards associated with the policyholders on the flip side. For example, people who are insured may reduce caution in preventing an insured event. So, for example, I'm a major skier and I do some very speculative things while I ski. And if I didn't have good health insurance, I may think twice about, jumping off a cliff in the backcountry. Additionally, what these insurance companies may do to try and reduce moral hazard is force policyholders to pay deductibles, which is just a specified amount of an insurance claim that an insurance company will never pay. And that objective is to reduce moral hazard. So you may hear, like on your auto insurance, that you have $1,000 deductible. That means that the insurance will only kick in after $1,000 worth of damage needs to be repaired. Up to $1,000 you have to pay for it on your own. And so the objective with that is to just put some liability back onto the policyholder. And to get a lower deductible, you have to pay a higher premium since all of a sudden there's more risk to the insurance company. Additionally, insurance companies have put in covenants that limit risky activities. So, for example, this is one that's really interesting right now because my brother has started driving for Shift. Private car insurance will never protect delivery drivers, and that just doesn't limit yourself to like Shift or Uber, but even for like pizza drivers. They do not want to insure it because that means that you're going to be on the road way more frequently in neighborhoods that you may not be familiar with. So it's a lot more risky for an insurance company. Instead, they make you take out a second public or commercial car insurance to make you pay more for them to take on that added liability of you driving so much more and being in areas and driving in adverse conditions more frequently. Additionally, the extreme situations, insurance companies also usually put in what are called act of God clauses that relieve the insurance companies from having to pay out claims for completely unforeseeable circumstances. And you may be hearing about these act of God clauses in the news, especially in the courtroom. And the big reason right now is because insurance companies have tried to invoke these act of God clauses in association to insurance claims that come from the events associated in the immediate aftermath of the death of George Floyd. We saw a lot of businesses getting broken into, looted, glass windows broken, property damage, etc. But these all this damage may not be covered by insurance because they said that, massive looting associated with a single death in the middle of a lockdown is a completely unforeseeable circumstance, and so they couldn't foresee it happening, so they weren't insuring that event. Whereas on the flip side, the obvious response is you insured my property in the event of property damage, so you owe me to pay me out the property damage. And it's actually really interesting for those of you that may be curious about law a little bit because these act of God clauses don't actually usually get brought up too much. You think of insurance companies being scammy, but they usually don't go to this extent to use this act of God clause. So it's interesting because it's going to set a legal precedent for what constitutes as valid under these act of God clauses and may significantly affect insurance premiums in the future.